question. So let me share it now. You can see my screen. Let me know. Can you see my screen?
Yeah.
Yeah. So the last time we met, we were able to look at, we started a question on the value of a company, how to value a business, right? So that's what we did the last time, how to value a business. And we were looking at free cash flows to equity, free cash flows. We have done internal multiple internal substitutions. We have done this. Let's check. Yeah, cash flow statement. So we have done all these. Then we go to, yeah, I think this question was what we were looking at the other day. And somebody told me I should go and work it out on another sheet, which on this our Excel sheet. And I think I did that day. Let me check which of them is it. Yeah, this is the workings. Now we came here, we came to check. Oh, I think this is what we're doing. Oh, this is Jatoko, different from what we did. Jatoko. Yeah, so this is Jatoko. Then what we are going to do is, okay, so this question now that we have here, this question says that, example, Tauto Limited. Now they say that the finance team of Tauto Limited has produced the following forecast of financial data. So we have the financial year, year 1, year 2, year 3, year 4. And here they say that net sales, we have, this is the net sales, right? So just like the way we normally have our sales, you list your cost of sales, you list your other expenses and all that. So that's the same method we are going to use. So the first thing we want to get is we want to get our net cash flows. That is the free cash flows that is available to the owners of the business. So the question, the tax they say we should do is they say that they say assume that the company's weighted average cost of capital is 14%. The market value of debt is 30 million required. Calculate the value of the company if the certain informations are considered. The first one is cash flows are expected to remain at X4 level into infinity. Now, when cash flows are remaining at X4 level into infinity, it means that the cash flows are, so whenever something is going into infinity, they call that, what they call that, I think, perpetuity. Who was in the last class when we looked at this question? Was anybody in the last class on the call when we looked at this question? We looked at perpetuity the other time. We said you could have perpetuity that is growing with growth, or you can have perpetuity that is not growing. So the formula for a perpetuity is always very simple. So the formula for perpetuity is simple. You simply say the cash flows of the base year, right, divided by the cost of capital multiplied by the discount factor of the base year. So if you look at this question, they gave us a weighted cost of capital of 14%. Whenever you are looking at free cash flows to the whole company, the best discount factor to use is a weighted average cost of capital that considers the risk of the total investment. However, if you're only told to use free cash flows to equity, then the best thing to use to discount this thing is the cost of equity. That's what you're going to use to discount this thing. So yeah, let's first solve this thing. Let's first get our free cash flow. Once we've gotten our free cash flow, then we can now go on to now start looking at what is required. So let's go to this our template and let's look at what we needed to do. So the first thing we're going to do is, I think the name of the company is Tauto Limited. Tauto Limited. So this is Tauto Limited, right? So we now come over here. We are trying to get computation of free cash flow to the company or to the company. So that's that. So how do we do that? The formula to use is we take our normally we ought to take our net our profit before interest and tax. Normally we ought to take our profit. So this is the format: profit before interest and tax. So that's the first thing you're going to take. So you take that stuff, profit before interest and tax. The next thing you want to take is you want to less. It depends on the one you want to get. If you want to get free cash flows to the total company, right? You don't need to deduct your interest. Normally, is interest we normally deduct first, but because here we are trying to get the cash flows to the total company, we are going to less taxation. So taxation is going to be at let's check the amount. Let's check the amount. Okay, then we pull this one here. So let's check. The question is that our corporation tax rate is actually 30%. So this taxation is going to be at 30%. So we're going to get what that figure is. We now put it in bracket. Okay, so that is our taxation. At the top, we're going to get what our sales actually is. So our sales, sorry, our profit before interest and tax, we're going to get it. So the next thing is that we now less our taxation. Right. Then after you less your taxation, the next thing is you want to add non-cash item. So you add the non-cash item, which in most cases is your depreciation. So which is let's say depreciation in bracket, depreciation. So in most times it's going to be depreciation. Then you're going to have it here. You're adding back, so you're adding your depreciation. Fine. The next you want to do is you want to now check: do you have any capital expenditure you want to work on? So you have to less it. You less any capital projects you have that you want to embark on. Projects, any capital project or any capital stuff you want to embark on. So you now put that in bracket. So you jacket it. Then the next thing you want to less is you less increase. When increase in working capital, is it working capital? Yes, in working capital, you less increase in working capital, you add decrease in working capital. So this is, I don't want to merge it together again because a lot of people may be confused. So you always less increase in working capital. So if your question is telling you that working capital is increasing, you have to less it so that we will make provisions for that working capital, right? We don't want to spend all the money, whereas we still need more working capital for the project. So if they tell you that they need additional working capital of 50,000, so take it away from the income you have so that you don't waste all of them. Because what we are trying to arrive at is the free cash flows that you can spend as you like. So take away all those things that are important that you feel that you need to invest in. So any increase in working capital, you deduct it. Any decrease in working capital, you are to add. So this is going to be deducted. So I'm putting this one in jacket. I'll put this one in jacket. So I'll put this one in jacket. Yeah, this is going to be deducted. Why any decrease is going to be added, right? So we're adding this one. Okay, so that's how we're able to arrive at that. So after you've done all these plus and minus, I think at the end of the day, there's no other thing to be done, right? If you are doing the free cash flow to the total company, at the end of the day, I think you will now have what you call your free cash flow to the company. So you're going to have it like this. This is going to be your free cash flows to the company. Now, however, if you are only trying to get the free cash flows to equity, it's going to change a little. So let's assume they are asking us to get free cash flows to equity, to only the equity holders. So we'll copy this. We come down here like this. We come and put it here. Assuming we are looking at free cash flows to only the equity holders. So let's come here. Let's click free cash flows to equity holders. Assuming that is what we have. So let's check what we change. We can start with our profit before interest and tax. The next thing we're going to do is we are going to now, the first thing we're going to do, because we only want to get free cash flows to only the equity holders, it means that we want to pay off the debt holders. So we are going to less our interest from here, less interest. When we less our interest, after we left our interest, then, okay, it's going to be in jackets. So when you less your interest, the next thing you want to do, you want to less your taxation, then you want to add your non-cash items, which is depreciation most of the time. You want to also less your capital project. You want to less your increase in working capital or add your decrease in working capital. Then the next thing you want to do is before you get your total amount, there are two things you need to consider. Two things you need to consider. You need to consider two things over here. So what you need to do over here is this. Number one, you need to, what's the word now? You need to, so you're adding decrease in working capital. Then here you need to add the cash received on the instrument issued. So the cash received when you issue that, the whatever you, so you know you are giving, maybe you are trying to raise a loan note, okay? So how much cash were you able to generate when you raise that loan note? You put it here. Then the next thing is that you now put also you less the loan repayment. So less the loan repayment. You come over here, put this one in jacket. So the loan repayment, you put it there. At the end of the day, you are going to have these free cash flows to only the equity owners, only equity holders. So that's what we are going to have over there. So free cash flows to only the equity holders is what we're going to have over here, equity holders. So free cash flows to only the equity holder. So are we following? Do you understand what I'm trying to say? Do you understand it? Hello?
I'm with you, sir.
Okay, so at any point you feel it's getting complex, do let me know so I can explain more. Okay, I can explain more. So let's come back to the file we are using. So once you understand what needs to be done, it makes it easier for us to solve whatever question we want to solve. Now, if you look at this question we were given, they told us that, let me make it smaller. I don't know if you can see it. Yes, so this is it. Now, the question they gave us is they say, example, Tato Limited, the finance team of Tato Limited has produced the following forecasts of financial data. The first one, we have a financial year, which is year one. I think it's up to 4 years. Let's see. Yeah, 4 years. So let me make it slower, more again. Okay. So I hope it's not too small. Can you see it?
Zoom it a little bit, sir. Yes.
Okay. So this is how it is. So yeah. Now let's check. Now they say that the finance team of Tato Limited has produced the following forecasts of financial data. So the first one, we have a financial year, which is year 4. So let's also come here and let's get 4 years. Okay, so let's come here. So we are trying to solve solution to Total Limited. So we'll come here, we'll say solution to Total Limited. Yeah, so the first thing we're going to do is we're going to have that financial year, then we shift, and here we have X1. Okay, X, let me leave it like this. So because this is going to be, oh, there's nothing here. Okay, so let me delete it from here. So I delete this one. Yeah, so we have over here we have X1, X2, X3, X4. So I'm going to take this now and shift it inside. Okay, so okay, it's making sense a little. Yeah, so this is what we have. Okay, so that's that. Now, what do we now need to do? The first one is the net sales. So we have the net sales for this year. Net sales, we have for the first year we have 230. The second year we have 261. The third year we have 281, and then the last year we have 298. Fine. Then the next thing we want to do is we have our cost of goods sold, which is going to be our costs of sales, right? So they told us that the cost of sales should be at 50%. So when I say at the bracket, it's going to be 50%, sorry, 50%. So here we can simply say, to get our cost of sale, we say equal to what is at the top, right, times 50%. We're going to get what is at the bottom. So we now close it at the bracket because it's going to be a deduction. Want to put it into a bracket and then multiply it by -1. Multiply by -1. Yeah, so we have gotten it like this. So 50% of 230 is going to be 115. So we just quickly copy these and get it to all these places. Yeah, so we've gotten that. Yeah, so that is correct. Then the next thing, they say that selling and distribution expense, they gave us the answer. So here we have selling, and distribution expense. So selling and distribution expense is going to be, here is going to be so minus 32 minus 34 because it's an expense, minus 36 minus the last one is going to be 38. So that's fine. Then the next thing, what's the next thing that we have there? We have our capital allowance. So that's the next thing. Yeah, we have capital allowance. So we have capital allowance here, and our capital allowance we are having is an expense also, minus 40 minus 42 minus another 42 minus another 42 as well. So that's how we're able to get that. Then the next thing we want to do is yeah, interest also. Interest is also here. But let us not forget that we need to get profit before interest and tax. So there's interest there, but we need to get profit before interest and tax. So let's quickly get our profit before interest and tax. So we now come over here to get our profit before interest and tax. We now say we sum all these things together. Yeah, that's correct. Yeah, so that's giving us that. So we now take all these things, we drag it over like this. Wow. Okay. So this is our profit before interest and tax. Then what is our formula saying? Our formula is telling us that. So yeah, let me put something like this over here. I'm coming. Let me do something like this here, or let me do it here. I want to check for something, alignment, front, table. Okay, so that's the answer. So we've gotten our problem before interest and tax. Now, because we want to work on, we are trying to work on, the value of the total company. So because it's the value of the total company we are trying to work on, we don't need to actually remove, our interest. So what we now do, we already have our profit before interest and tax. So the next thing we have to do is that we now say less our tax. That's the first thing, less tax. And tax is at 30%. So tax is, oh, I put 39, is at 30%. Tax is at 30% according to the question. So we now say equal to this multiplied by 30%. We get our answer. So then this is our answer. I want to put it times -1. Close the bracket. Come here again. Close the bracket. And come here, multiply it by times -1. And that is how we have that. So we now come here, we now pull this from here, drag it all the way down. We drag it fine. So this is how we're able to get the first tax. So we are just following this format. This format is what we're following. The first one is to get our profit before interest and tax, right? Then you less your taxation before you now start lessing your capital allowance and any other thing. So when we come back to this place, we've done our profit before interest and tax, which we've gotten like this. Then we've less our tax. What's the next thing to do? We need to add back non-cash items. So add back capital allowance. So capital allowance is what represents our non-cash item now. Capital allowance. So our capital allowance now, we now say that we are adding back capital allowance. We now say equal to this, sorry. So to this times -1 to make it pause. Yeah, so we're adding back all these things. Then we now come here and we drag like this, like this. Okay, so fine. So we have been able to add back our capital allowance. Now, the next thing you want to do is you now ask yourself, do I have working capital? Did they give me any information about working capital? So let's check the question. They say, incorporation tax is at the rate of 30% per year, payable in 1 year, payable in the year that the taxable cash flows occurs. Then after that, assume that the company's weighted average cost of capital is 14% and the market value of debt is so amount. So here they didn't give us capital, working capital. They didn't give us working capital, but did they give us, apart from you adding back your non-cash item, the next thing you want to do, you want to ask yourself, we need to less our capital project that we have. So is there any capital project? Is there any capital project you need to less it? So in the question, they gave us some capital project. They say that cash flows needed for asset replacement. So the cash flow that is needed for asset replacement, we have the first one to be 50,000. So we are lessing it. So because it's going to be less, we just put -50. We are lessening it. The next one, we are going to put -50. The next one is -52. The next one is going to be minus 55. The next one is going to be minus 58. So that's how we're able to get all those things. Now, what else? We need to check whether we have working capital. Sorry, we have working capital. Working capital. And do we have working capital? So if there is an increase, we had. If there's a decrease, so if there's an increase, we had. If there's a decrease, we less. But we don't have any. So let's put 0, 0, 0, 0. Now, since we have all these, then at the end of the day, we can now sum to get what our answer should be. So let me come and copy what is here. Copy and Ctrl C. Come over here and Ctrl V. All right. So let me now check. Here is going to be all equals. No, I want it to be here, from here to here. Enter. Okay. So I want to take this. I want to drag it all the way. All right. So this is what we are able to get. So we have been able to get this. Then the next thing we want to do is we want to now use our discounting factor. In the question, our discounting factor is they give us discounting factor of 14%. So now say DCF is at 14%. So you already know how to discount now. Now, if you are looking at these are cash flows. Now we've gotten our cash flows. So let me call this cash flows. But yeah, so these are our cash flows, free cash flows actually. Then we need to discount it to be able to get our discounted cash flows, because that is what we use to get the value of a business. We must discount the cash flows using the working capital that is given to us so that we can get the value of the business, because all these cash flows are in the future. Look at this one. This is in year 1. This is in 2 years' time. This is in 3 years' time. This is in 4 years' time. But we want to get the value as of today, right? I want to get the value as of today. So we need to discount it to present value. So that's what we want to do. So if you are discounting at, since the cash flows are not the same, the cash flow, we have 20 here, we have 28 here, we have 30, we have 32. So to discount it, we are going to use single period discounting method. Give me 2 minutes. Hold on. Oh. So now let's now move on. So discounting now at so we want to discount. So what we're going to do is we're going to say equal to, want to get the discounting factor, right? We open our bracket, we say 1 over, we open our bracket again, 1 plus R. What about R? 1 plus R. Our R is 14%. 1 plus 14%, right? We close our bracket, then we raise it to power 1 here, right? Then we close our bracket again. So 1 over 1 plus R raised to power n. That is the discounting factor. Is there anybody on this call that does not understand how to get the discounting factor? Anybody on the call, indicate so that I can explain more on discounting factor. I guess there's nobody that doesn't know. We all understand it. Am I right?
Yes.
Are you sure, Madam Ibukun?
Yes, yes.
Okay, the next person, Dio.
Yes, I can. Yes, I understand, sir.
All right, no problem. If you say you understand, I believe you. Okay, so we've been able to get the discount factor. Now, the reason why we are not using annuity is because these cash flows, they are not the same. Assuming these cash flows are the same figure, maybe we have 20.1, 20.1, would have used annuity formula, okay? But because they are not the same, so we just maintain our normal whatever. So this information, we can drag it over here, but let me see what is happening. Yes, why is it okay? So yeah, but now because this is year 2, we now come over here and then we change this our n. You know, this is our n here. We change it to 2. We change n to 2. Then this one also, we change our n to 3 because this is year 3. We change n to 3. Then the last one, the n here, we change it to 4. We change this one to, we change it to 4. And that is it. So we have been able to get our discount factor. So let me reduce the numbers of decimals that we have over there. I want to reduce the decimals. Okay. I want to reduce the decimals. No. Decimals. I think this is good. Yeah, so let's leave it at this. So I've reduced the decimals that we have there to something like this. So now this is our discount factor now. So the next thing you want to do is that you want to now get your net MPV, net present value. So by saying equal to your cash flows multiplied by your discounting factor. So, and then you're going to get this. So this is what we're going to now extend all the way. All right. So that's how we're going to get this. And we can also reduce these also to the barest minimum. Let's check this. Okay, so I think we're good like this. So this how we're able to get our MPV. So yeah, we have been able to get the value of this company from year 1 to 4. So this is going to become MPV, like the value of the company. So you can say in brackets, value of company from year 1 X1 to X4. So we have been able to get that. So that is that. So that's how we're able to get that. So that is how we're able to get the value of the company. So to get the value of the company, you simply take the free cash flows, and then you now, when you have the free cash flows, you now discount them using the discount rate in the question. So when you do that, you're able to get the value of the company from year 1 to year 4. So the examiner, they are not pleased with that. That is not what they want. They now told us that required calculate the value of the company if, number 1, cash flows are expected to remain at X4 level into infinity. Now we already have our X1, we have our X2, we have our X3, we have our X4. So they say this is our cash flow. If our cash flow remain the same at X4 level into infinity, okay, so it means that our cash flow, we've got a cash flow. So let me come here. We say value of company from X1 to X4. We already have it to be, so let's add it equal to, right? We now say sum, open our bracket. We now come here and we select the range. Oh, sorry. From here. So we now close our bracket. We click on enter. Yeah, so this is the value of our company from that period. So this is the value of our company from X1 to X4. Now the next thing we want to do is, but before I do that, let me compare our answer to each other. Let me be sure that we are getting it. So this is like 28. What is this? What change? This is okay. Could it be because I discount factor 20? Okay, yeah, I'm having 21. Yeah, I have 28. Here I have 30. Then I'm coming, let me check. 30, here I have 32. So 32.3, which is not bad. Then we have our discounting factor. Okay, they reduce it to three stuff. So this is okay, still fine. Then we have 17.50, what 21 point something, 20 point, 18 points. So this is now 19. So we are not far away from each other. We are very, very close. Okay, so that is fine. So we are able to see the present value from year 1 to year 4. And this is what we are having over here. So let me reduce this from this number of decimals. I want to take away 1 decimal from it. Yeah, so we now have something like this. So it's just rounding off. So we're able to round off and all that. So that's why our own is different from this. So now when we come here, what we need to do is let's go back to the question, right? So the first thing they told us to do is that they say that assume the cash flows is expected to remain at X4 level into infinity. So it's going to stay constant at X4, right? And go straight into infinity. So what does it mean? We have gotten our X1 to X4 to be this. This is value of the company, right? Then we now say present value from 1 to infinity is what we are looking for. We now say present value from X5 to infinity. Infinity is what we are actually looking for. So what is our X5 to infinity? Now our cash flow already is staying constant from X4 to infinity. So now what we do, whenever you have a cash flow that is remaining constant from 1 point to infinity, we say that is a perpetuity without growth, a constant perpetuity. However, if you have cash flows that stay constant from 1 point to another point, right? Assuming they told us that cash flow is going to stay constant from point X5 to X7. So it's staying constant. That is going to be annuity, right? But because it's going into infinity, it's going to stay constant into infinity. That is where we have a perpetuity. So there are two types of perpetuity. We can have a perpetuity with growth. We can have a perpetuity without growth. So this is the formula for perpetuity. Now here I say notes. Okay, notes whenever cash flow remains the same from 1 point to infinity, comma, we have a constant perpetuity. Here we have a constant this my spelling is not correct. Perpetuity. So we have a constant perpetuity. So here we need to wrap this thing round. Let's wrap it round. So we come here, we wrap it round. So let's come here. How do we wrap? Alignment, number, wrap. So let me click on this. Let me see. Yeah, wrap. So merge. When I merge, I want it to be up. I want it to stump like this. Then I wrap it. Okay, so this is it now. So you can see we have we're having a constant perpetuity. So we're having a constant perpetuity. Whenever cash flow remains the same to infinity, it is a perpetuity. But because the cash flow is remaining the same, the cash flow is not changing. So that's why I'm calling it a constant perpetuity. So what's the formula? The formula for it is this. Let me show us. Formula for a constant perpetuity. We are saying that cash flows or the constant cash flows, okay? Cash flows that is constant, right? Divided by the cost of capital given to us in the question, cost of capital in the question, capital in the question, then you now say, is it multiplied? After you've done that, then multiplied by the discount factor of the base year. The base year, okay? So now let's now use this now. So that is for constant perpetuity. However, if you have another perpetuity that is not constant, then we are going to have a growing perpetuity. To get a growing perpetuity, let me quickly put it here. Growing perpetuity. When you have a growing perpetuity, this is what you do. You are going to still have the same cash flow of the base year. So you are going to have cash flow of base year. Okay, cash flow of the base year. Then you now say in brackets, in brackets, 1 plus the growth rate, 1 plus G, okay? When you have that 1 point G, then you now divide it by costs of capital. Then the cost of capital you're going to minus G from it, minus G, minus the growth rate from the cost of capital. Then after you've done that, everything you now multiply it by the discount factor of the base year. So what does it mean? It means that your constant perpetuity, right, is cash flow of the base year divided by cost of capital given in the question, all multiplied by discount factor of the base year. So what is the base year in this question? The base year is cash flow is remaining constant from year 4. So year 4 is actually the base year, right? So we now say, what is the cash flow of year 4? Cash flow of year 4 is 32.3. That is the cash flow. What is the cost of capital in the question? Cost of capital in the question is 14%. What is our discount factor of the base year? Discount factor of the base year is this discount factor that we got for the base year. This is what we are doing to multiply whatever we have. So now, if you understand the constant perpetuity, to get the growing perpetuity is simple. The top, add growth rate to the top, right? Add the growth rate to the top, then the bottom minus growth rate from the bottom, then your discount factor of the base year remains the same. So we are saying cash flow of the base year plus the growth rate, right? Plus the growth rate, then divided by cost of capital in the question minus the growth rate. So the top, add growth rate to the top, less growth rate from the bottom, then multiply it by the discount factor of the base year. So let's now start working. So because we have a constant perpetuity, we are going to use the first formula, which is cash flow of the base year divided by cost of capital given in the question, multiplied by discount factor of the base year. So we now come over here, we now say the cash flow of the base year is actually 32. So we now say 32 point, what is that? Yeah, 32.3, right? 32.3. So let's start with an equals to. And I'll say equal to, we open our bracket, we say 32.3, then we divide it by, 32.3, right? Divided by the cost of capital, which is 14%. We'll close the bracket, right? Then you now multiply it by times, you now come and pick the discount factor of the base year times this. Oh, wow. Okay, times 0. So let's get this one first. Okay, so let me delete this one first. So let's get this one here first. Then we now say that to move on, we now say equal to this times the discount factor of the base year. We click on it. So that's how we're able to get this answer. So this answer is only the the cash flow of the base year. Cash flow of the base year. Okay, let me move it away from here. So the cash flow of the base year, right? Inside here, we have the cash flow of the base year divided by the cost of capital given to us in the questions. So let me put it at the side. Cash flow divided by costs of capital. So that's how we're able to get this value that is here. Now, this one now, let me also shift this one and move it away from here. Yeah, so this one now, we now have the result or the answer above, multiplied by the DCF of the base year of the base year. Okay, so that's how we're able to get this answer. So here we have gotten here, we have been able to use our perpetuity, our constant perpetuity, to get the value of the business from year 5 to infinity. Now, to now get the total value of the business, we need to add our year 1 to 4. We need to add it to our year 5 to infinity. So now say the corporate value, so I think corporate, there should be R, corporate value equal to, so our corporate value equal to the value of the company from year 1 to year 4, which is this, right? Value of the company from year 1 to year 4 plus the value of the company from year 5 to infinity. And that is how we got the total value of the business. Then the next thing we want to do is that since we have gotten the value of the business, the total value, in the question they gave us the value of debt. They give us the value of debt to get our, so here in the question they say the market value of debt is actually 30. So to get the value of I'm trying to get the value of equity, right? We now say that less value of debt. So we want to less value of debt. So now say equal to this minus 30. So when we do that, we are going to get this. So this is our value of our equity. So let me do something. Let me put 30 here. I don't want to model it up. There's 30 here. So at the bottom, I want to say, and I'll say that value of equity, it will be equal to this one here, right? Minus this one at the bottom. And then that's how we're able to get this value. So we have gotten the value of equity. Here we have gotten the value of the business, the corporate value. So let's go and check what we've done and let's compare our figure. We can see that obviously the only difference is just our rounding off errors. So everything that I've told us is how they got all these things. These are the good things. Then I did a lot of explanation, so much explanation here, just to try and give us all the formulas, constant cash flows times different part of the base year divided by cost of capital. I went further to, okay, so you can see, yeah, so see rounding of error, 136. Here we are having 135, fine. So this is like that. So we now take our year 1 to year 4, we have this value. Then year 5 to infinity, we have this value. So that's how we're able to add it together and we get this 215, whereas it got 213, rounding of error. Then they now say that to not get our value of equity alone, we take the corporate value minus the value of debt. We're going to have our value of equity. And that's how we're able to get the value of equity over here. So any question at all?
There is question.
Okay. Mhm.
So you need to come again from cash flow divided by cost of capital. I don't know how you got 230.71.
Okay, are you just on the call?
No, sir.
Okay. So you say cash flow divided by what?
That's from after the formula of a growing perpetuity. So after this formula of a growing perpetuity, or the calculation under cash flow divided by cost of capital, which is 0.14.
And what we cash flow divided by give me 0.14. Okay,
Our
so
cost of capital is 14%. That's 0.14.
yes. So
So
what is
what do
the
you multiply?
what?
What do you multiply it with, or what do you divide it with?
Okay, yeah, that answer is uh, okay. So this is what we did, right? This is what we did, and it's surprising. So anytime you are having, so let me explain something to you. Whenever you are having, if you take 14% and you say 14 divided by 100, what will you get? What will you get?
That is 0.14.
Fine. Anytime you are doing something and you're dividing it by the denominator, right? So if you divide that thing by that denominator, the denominator is going to gross that thing up from 32. You know, if you take care, this is the cash flow of the base here. So it's going to gross it up from whatever it is, going to gross it up to 100%. So in that gross, this is, it assumes that this amount you have at the top is actually 14%. You now gross it up to 100%. That's why you have 230,000.71. So we went to check for the discount factor of the base here, which is this. Remember, sorry, cash flow of the base here, I mean to say. So if you check, you know that they say the cash flow of the base here is going to remain constant at year 4 to infinity. So is this 32.3 that we took, and that is what we now divided by the cost of capital that was given in the question. Then whatever answer we get, we now multiply by the discount factor of the base year. So what we did here is that we say the cash flow of the base year divided by the cost of capital is what we did, and that's how we got this one. Then when we have gotten this one, we now say the next step is to multiply it by the discount factor of the base year. And our discount factor of the base year is actually this. We have 4 is the base year actually. So we now say multiply by this. Okay,
Okay.
0.5921.
Okay.
So multiply it by that, and that's how we're able to get this amount.
Okay.
Right? So since we have gotten this amount to be the value of the company from year 5 to year infinity, we simply say to get the total value, the corporate value, take the value of the company from year 1 to year 4, add it to the value of the company from year 5 to infinity. And that is what we did. We now took the value of the company from year 1 to 4, we added it to the value of the company from year 1 to 5, right? And then we are able to get the corporate value. Now, from our corporate value now, we now less the value of debt so that we are going to have the value of equity. Are we together?
So I want to press calculator to confirm the what you did.
Okay.
Okay, sir. Yes, sir. We are together.
Okay. So is there any other person on the call that doesn't understand what we are doing? If you're on the call,
Understood, sir.
okay. Okay, so fine. That means we are all together. We are all together. Okay. So please mute your mic. Your mic. Yeah, there's a distraction. Your this thing is distracting us. So if that is noted, then we shall move ahead. Okay. So what we are going to do now is yeah. So we are done with the first question, and I believe everybody understands the first question. So let's look at the second question. The second question that we are told to do is this. They say cash flows are expected to remain at X4 level, okay, up to the end of 14 years horizon. Cash flows are expected to remain the same at X4 level up to the end of 14 years horizon. What does it mean? Whenever cash flow remains the same at at from a year to another year, right? What formula are we going to use? We already told us that when cash flows remains the same from one point to infinity, we say that is perpetuity, right? And we look at the formula for a perpetuity. And we say whenever cash flow is growing from one point to infinity, we also say it's a perpetuity, but it's a growing perpetuity. But what happens when cash flow remains the same at one point to another point? What are we going to use in this case? Who can tell me? Is there anybody that want to? Is there anybody that want to try?
Constant perpetuity.
Constant perpetuity. No. Perpetuity is only used when something is going to infinity. Do you understand? So perpetuity is only used, right, when something is going to infinity. But in this case, this stuff is not going to infinity. It has a end. It say to end at year 14. So that can be a constant perpetuity, madam. It can be a constant perpetuity. So what would the answer be? Who can tell me?
Growing perpetuity.
Ah, okay. Now I told us that it's only when something is going to infinity. I'm saying it again. It's only when you see the word infinity. When something is going to infinity, that's when we call it a perpetuity. If you didn't see infinity there is nothing that is perpetuity, or it's not a perpetuity. So now let's just assume we don't know what it is. So let me teach us what it is now. Whenever cash flow remains the same from one point to another point, right? So definitely we know that it's not going to infinity. We know that, okay, it's from 0.4 and it's going to point like a point, let's say point, what's it called now? It's going to point, let's say 14, right? So this is what they call this is what they call annuity. It's an annuity. It's not a perpetuity. It's an annuity. Are we together? Are we together? Can anybody hear me? Are we together?
Yes, sir.
All right. So if you're together, that's fine. Then let's now look at how to solve this other question. It's important for us to learn how to solve it. Okay, so to solve this other question, we are going to do something. Hold on. You can mute your mic, so that there won't be there won't be noise in the background. So you can mute your mic. So now what we're going to do now is this. So here, we already know our cash flows from year 1 to year 4. Then we now want to know our cash flows from year 5 to year 14. So this is what we do. Okay, this is what we do. We say that is question 2, right? So this is question 2. Okay, question 2. All right. So this question 2 now. They say that cash flows are expected to remain at X4 level up to the end of 14 years rising. Okay, so 14 years rising. So what are we to do? So let me wrap this text, wrap this text, So let me wrap this text like this. Yeah, I want to see it like this. So let me come here. Alignment, merge, raise it up to the side, and wrap. Yeah. So this is it now. So cash flows are expected to remain at X4 level up to the end of 14 years horizon. So this is what we're going to do. Now, because cash flow is going to remain constant from X4 to whatever, we first say that, okay, our present value of X1 to X4 has given us this value. So we say equal to, hold on. So we say equal to, what is that our answer for X1 to, so this is our X1 to X4, right? Because of this, we already have this already. Okay, so now we're not looking for present value of X1, X5 to X, is it 14? Yeah, so that's what we are looking for. We're looking for that amount. So to get it, whenever you have an annuity first, you have an annuity from year 5 to year 14. So what you need to do is that you've gotten year 1 to 4, right? What you need to do is that you now say, okay, you are going to have your cash flows. So let's do it the way we normally do our normal this is. So we say we have our years. We have our years, right? After we have our years, we have the cash flows. We have our discount factor. We have our present value, right? So what is the year? From first we're going to get year 1 to 14. We're going to get year 1 to 14 first. So what is our cash flow? Our cash flow is actually, our cash flow that is remaining constant is what? 32.3. I mean, cash flow is 32.3. It's going to remain constant, right? Then we want to get the discount factor. When you are trying to get an annuity, this is an annuity, okay? So let me put a note here. Whenever cash flow remains constant from 1 year to another year, we have an annuity. Okay, we have an annuity. So let's wrap this test around. This test is going to be fine everywhere now. So let's wrap it around. So come over, click on alignment, click on merge and center, click on the up alignment, click on the side alignment, then you now have the text. Yeah, so that's how to wrap the text. Okay, so now we've wrapped this text. So they said, note, whenever cash flow remains constant from 1 year, from one year to another year, okay, we have an annuity. So what is the annuity formula? So let's now check what the annuity formula is. So annuity formula. Is anybody here that understand, that knows annuity formula? Hello? Is there anybody on the call that knows the annuity formula?
Yes.
Okay, so what's the formula?
That's 1 minus. I should
Okay, go on.
continue.
Continue, please.
1 minus into brackets 1 plus r, bracket close minus 1 over r.
Okay, so now to get your annuity, let me just use the normal discounting factor to explain. So let me come to the top. Now this is cash flows, right? These are the cash flows, right? Now, if you check this cash flow, they are not the same. This is 20.1, this 28.15, this 30.75, this is 32.3. They are not the same. Assuming we have 20.1 here, 20.1 here, 20.1 here, 20.1 here, we would have used annuity for it, right? So now that means that whenever cash flows are different, they are distinct, there is a discounting factor that we normally use for distinct cash flows. For distinct cash flows, right? For cash flows that are different, there's a discount factor that we normally use for it. So for that discount factor that we use for single period cash flows, so let's come here. Let's say discount factor for for single period cash flow. So it's discount factor for single period cash flow. So we're going to have like there are two methods, okay? Single period, when the cash flows are not the same. So the first one we're going to say, the first one is going to be you say 1 over where is my over? Okay, 1 over 1 plus r, right? Then whatever you get, you now raise it to power n. Whatever you get, you raise it to power n. So here, you now take this one, you raise this one to power n, raise to power n, raise to power n. Fine. So this is one method, right? This is one method. There's another method again. You know, here we are saying 1 divided by, like we are dividing 1 by 1 plus r raised to power n. Fine. So there's another method that we always use. The next method, number 2, we have what we call okay, hold on. What's happening? Let me read this one again. Oh, I put a comma. Oh, beautiful. F2, yeah, and a comma. Right. Yeah, so that's it. Now the next method we are going to look at, open our bracket, 1 plus r, close your bracket. No, let me use this r. 1 plus r, close your bracket. Then we'll now say raised to power minus n. So this is the method that we use for discounting, right? So this is you can use this one. You can also use this one. Whenever your cash flows are distinct, they are not the same. They are distinct. You can decide to adopt any of these discounting formulas, and you are going to get it. So what I'm trying to now tell you is that when you now have an annuity, annuity is when all the cash flows are the same, just like we have it here. When they say that, yeah, they say cash flows are expected to remain at X4 level up to the end of 14 years horizon. So when you have cash flows remaining the same, then annuity is calling you. So how do you get your annuity formula? So the formula for annuity is to take this single period annuity. You see this one I have minus n, the one that have minus n, okay? That we don't have 1 over. So this one you're going to take. Just take this one like this, copy it, and come and put it here. So let's put it here, or let's put it here, right? So the next thing you are going to do is, let's edit it and put 1 before it. 1 minus, so this I is going to be, so 1 minus 1 plus r raised to power minus n. Then the next thing under it now, you now under it, underneath, right? Underneath, right. So under it now, you want to have your r. You now come here, you have your r. So raise the power r. Then we now click on enter. Then we come over and align it to the right. Yeah, so this is how we have it. So here we now have, so this is how to get your annuity. To make it easy for you, for those of people that don't want to start cramming or they don't know how to get it, it's simple. There are different ways to get it. Once you know single period discount factor, okay? Once you know single period, when your cash flows are not, there's nothing similar about your cash flow. Your cash flows are different from each of the year. So this is single period discount factor that we use. And is this single period discount factor that we use? That's what we use to get our discount factor here. Okay, that's what we use to get our discount factor here. So when you have your annuity, you are also trying to get a discount factor to use to discount what we have. We are also trying to get a discount factor to discount what we have. So therefore, we need, no, let me put it at the middle. Yeah, so therefore, that's why you see I arrange all these things, the years, the cash flows, the discount factor, the present value. So we say from year 5 to 14 is remaining the same, right? So whenever you are getting from year 5 to 14 is remaining the same, you cannot jump year 1 to 4 because already we've already gotten answer to year 1 to 4, right? The question is saying cash flows remain the same at X4 level up to year 14. We already know what X1 to X4 is. We already know that this is the amount, but X5 to X14 is what we are looking for. So what do? First of all, use the annuity formula to first of all get 1 to 14. Once you have gotten 1 to 14, then you now also get 1 to 4. Take it away from 1 to 14 so that you get 5 to 14. So 1 to 14, we are going to get our discount factor for it. How do you get it? 1 to 14. So here now, you have your 1 minus, open bracket, 1 plus r raised to power minus n divided by r. So here, what is our, let's put our formula here. We now say equal to, we say equal to, right? We now say 1 minus, open bracket, 1 plus r. Our r is 14%. 1 plus 14%, right? We close bracket. We now raise it to power. I'm coming on. Raise to power minus n. So what's our n going to be? You can tell me. What's our n going to be? The lady that gave me the annuity formula, I expect you to know the answer. What will our n be? The lady that gave me the answer, is she still on the call?
14.
Yeah, so your n is going to be 14, right? So, yeah, it's correct. It's correct. Thank you. So your n is going to be 14, right? We have year 1 to year 14. So the highest number is what you're going to put as your n. So the highest number is what you're going to use as your n whenever you're doing annuity formula. So we now say 1 to 14. We now open our bracket and all that. So let's close this bracket. We close this bracket. We also come here. We close this bracket from here. So we also close this bracket from here. So let's press enter whether we will not get error. Oh, fine, beautiful. So now don't forget that we have not divided it by our r, right? We've not divided it by our r. So what are we going to do? We are going to divide this thing by R. Our R is 14%. So we now say, let's now come here. We now say divided by 14. Oh, sorry, 14%. Right? We now click on enter. So this is what it's going to give us. It's going to give us this value. So let me shorten it. I don't want it to be this long. Gets me scared when it's long. Right. So we now divide. We shorten it to, okay. So this is good. So this is the discount factor that we are going to get. So to now get, so instead of us just moving on like that, let's also now get let's also get like let's get something. Let's now do one, because we don't need 1 to 14. Let's do 1 to 4. Okay, so 1 to 4. 1 to 4. We have our 32.3 here. Sorry, 0.3. So let's get this. So I'll just press Control D. Then I will not edit this one. Don't forget that here is 4. 4 is the largest number, not 14 here. So this is going to be 4 here. Fine. So we've gotten discount factor of 1 to 4. So the next thing we are going to do is that we're going to say this one minus this one. So to now get discount factor of 5 to 14, right? Putting our 32.3 here, we now say equal to discount factor of 1 to 4 minus discount factor of 1 to 14 minus discount factor of 1 to 4. We're going to get what 5 to 14 is. So this is what we're going to get, right? So when you get this, then you can say, to get our present value, you can say equal to this multiplied by, I think so. Then let's click on enter. So we can say from 5 to 14 is this. Then from 1 to 4 is this. You can see my screen. Are you sure it's not from your end? Is it the same for everybody?
No, I can see your screen.
Okay, so if you can see my screen, kindly leave the call. Kindly leave the call and try and join again. So you can see what I just did, right? That's what I just did. What I did here, they did 1 to 14 with this, they got this, which is correct. Then 1 to 4 is this. Then we now got this to this, which is this. And then when we do our multiplication, we are getting this. Yeah, we're getting this. Yeah. Okay. We are getting this. Yeah. So that's that. So at least you understand how we got, you understand what we are doing. Abi? Is there anybody that is lost on this call that does not understand what you are doing? Is there anybody lost on this call that does not understand what I'm doing? Hello? The lady that said she was lost, has she been found now? There's a lady that was lost before. I hope she's found. Okay. So I just wanted to keep this here, and this our annuity formula. Let me also take it from here. I also want to move it. I want to move it down to somewhere here. So let me create space for it. Let me create space for it. So here I'm going to do something like this. Okay. So let me create space for it. I'll do something like this. All right, so I think this should be enough, but let me put one more or two more. Oh, yeah. Yeah. Okay, fine. Let me now take this one from here. Okay, so let me take this one. All right. Pick it and drag it down. Yeah. Yeah. Fine. That's fine. That's fine. That's fine. That's fine. That's fine. Okay. Let's. Yeah, we are good. We are good to go. We are good to go. Go, 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 go. Okay. Okay, so I believe that so this is the question actually. They say cash flows are expected to remain at X4 level to infinity. No, sorry, to 14 years horizon, right? And I've been able to walk us down to get how to get our annuity formula, going by the single period annuity, sorry, the single period formula of discounting factor to getting our annuity. Then from there, we now went further to now solve this question, right? So we are looking at it that, okay, from year, we are trying to get year 5 to year 14. And cash flow is going to remain constant from that period to that period, but we cannot jump. We can't jump the gun, right? For us to be able to get 5 to 14, we have to, because it's annuity, we have to start from 1 to 14 first. We got our discount factor. We also now did, because we have gotten 1 to 4 before, we now did 1 to 4. We also got our discount factor, right? We now say the discount factor of 1 to 14 minus discount factor of 1 to 4, we got this value. So when it is that one that we now called 5 to 14. We now say this value multiplied by this value gave us this value. So how do we now get the corporate value now? So let's now come here. Let's copy something from here. We now come here. We now say from here, like they want to copy this like this. We want to copy and we want to bring it down, 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 not down. Okay, we'll bring it down here. On to V. So here, our corporate value becomes equal to, we now pick our 1 to 4, right, plus our 5 to 14. We now add it together. Then the next thing we want to do, our value of debt was given to us in the question, which is what? 30 million. So what, to get our value of equity, we are simply saying what is at the top, which is this, right? So let me query it. Yeah. So we are simply saying this is our corporate value minus our value of debt, and we're going to get this value. So that is how we were able to solve it. So any question? Do we have any question? Can we move on? Are we good? Any question? Any question?
I'm sorry, so how do you get the corporate value?
Can you see the way I got it?
Yes, sir.
Okay. So somebody should read the second question, the next question for us.
Sorry, sir. I want to understand something
Okay.
before the next question. So I want to understand that corporate value is the same thing as NPV, total NPV for the period.
Yeah, in a way.
Okay. Okay.
But there's a difference. Can you hear me?
Yes, sir.
Now, when you are doing MPV, You are only concerned about your cash flow. But what we are doing, this one, the value of a business, we are concerned with free cash flow, not any cash flow. It's a free cash flow that we are doing that's making us to get the value of the business. So when you take the free cash flow, not any cash flow at all, it's a free cash flow. After you've taken your profit before interest and tax, you've done all your additions, all your subtractions, you've gotten your free cash flow. Is that free cash flow now that you will now discount the present value to get your value of the business? So it's not any cash flow at all. Though you follow the same route when you're trying to discount cash flow. Cash flow are always in the future. You want to discount them, but what kind of cash flow are we talking about here? We are not talking about any cash flow at all. We are talking about a cash flow that is free. Free cash flow is what we're talking about. So that's the major difference between your NPV and your free cash flows. Do you understand?
Yes, sir. Thank you, sir.
Yeah, so that was good. So let's now look at the next question. Somebody should kindly read the next question for us. The next question. Somebody, kindly. Somebody should kindly read the next question for us. Or are we tired?
Okay. Oh no. Okay, so cash flow are expected to grow at a rate of 3% per year after year 4 with overall horizon
Of 14 years, right? Yeah, right? Do you see that of 14 years?
Yes, sir. Yes.
Okay.
Something. Yes.
Okay, so that's one.
Okay, I should read everything, sir.
Yeah.
Okay. And also calculate the value of the company if the cash flow are expected to grow at the rate of 3% per year after year 4 into infinity.
Okay.
Calculate the value of the company if the cash flow are expected to grow at the rate of 5% per year after year 4 to year 6 inclusive, and then to 4% in, I can't see that, in indefinitely.
Okay. So fine. So let's keep number 3, because number 3 is the most complex of all. Number 3 is the most complex of all. Let's keep number 3. I want you guys to do number 4 for me. Do number 4. I know you should know number 4. Look at number 4 and look at what you can do in number 4. So let's answer what number 4 is. What were we told to do in number 4?
We were told to calculate the value of the company if the cash flow are expected to grow at the rate of 3% per year after year 4 into infinity. So
Okay.
here we are going to use growing perpetuity.
Yes, that's
If
it.
I'm correct.
So yeah, let's try. So let's look at that formula for growing perpetuity so that you understand it well. Let's check this place. So this is like the formula, exactly the way I told you is going to be. You have your cash flows of the base year, right? Into bracket 1 plus G. You close your bracket. Then you now say divided by cost of capital minus the growth rate. Then you multiply everything by the discount factor of the base year. So I give you guys like the next 7 minutes to answer that. So you have to do this number. So you can quickly take a screenshot. Take a screenshot of this place, probably. Maybe this will guide you. So take a screenshot of this place and let's see whether this can guide you on what you're doing, because you need the formula. Is anybody taking the screenshot? Or let me
1 minute, sir.
Okay, let me read this one a bit bigger. Okay, so I think it's better this way. Take the screenshot like this. right? So that I can have all the formulas, both the growing and the non-growing. Take the screenshot. Have you done that?
Yes, sir.
Okay, so now let's now go back to the beginning. Yeah, you need to do this for me. Now do this one for me. Let's see whether I can do it. Okay. So I will get back to us in the next, let's say next 5 minutes. I will get back to us. So let's start.
I'm done, sir.
Okay, so I want to believe everybody has done it. Have we all done it? Did we all get it? Did we all get it?
I got 438.946.
Okay, so what about other people? Other people, did you get it as well? Okay, so this is what we're going to do. Take the screenshot of the total question. Take the screenshot of the total question. So can you try and take the screenshot of the total question? So let's have that also with us, so that all the questions that we've done number one, we've done number two. I told you to do number four, right? So that next time we meet, we are going to do number three and the last one. So take the screenshot of everything. You are going to use that to work for me. You're going to redo your cash flows, right? Then when you do that, you're going to solve from number one, number two, and also number three. Then leave sorry, you know the one I asked you to do now, your number one, number two, and number four is what you're doing. Leave number three and number five. We'll do that together next time. So we just take the screenshot and we call it today for year, so that we can go and prepare for the next topic that is coming up, which is going to be your who's going to be, let me check. I think the next topic coming up is it audit? I think so. So on that note, thank you everybody for your time, and see you later. Is that fine by us?
I've not screenshot
It
it.
doesn't mean as if they're coming back for a second.
Come again, I didn't get you.
Okay, I mean when you say later, we still coming
Repeat your
back for
question.
SFM.
No, we are not coming back for SFM today. Your
Okay.
SFM is going to end by,
All right.
isn't that 3:30? Yes, so use that, use that
Yeah.
period to get your hands
Please.
on this. Use a period to get your hands on this, and yeah, so that is that. So with that being said, I want to say so that is that. I'm sure you must have screenshotted it already. So do have a lovely short break till you meet your audit tutor.